I like Mr. Koo very much. He likes to solve problem. I create problem. That's the difference between between back office and front office. I always on the front office. Jokes apart, I have been making a lot of presentations in investment seminars and media interviews during my career. Almost all were in relation to analysis and opinion on the investment markets, such as bonds, FX, or stocks. Yet, speaking in front of a large group of students in a renowned university and trying to convey some useful tips for your future careers, this is only my second time. And I feel particularly honored because Hong Kong U is my alma mater. At the same time, I am a little bit nervous, as you can see. I need a... Why I am nervous? It is because of my first time speaking in front of a large group of students was a total disaster. It happened almost 30 years ago when I delivered a speech to a group of students in a university in the United States. In the late 80s of the last century, in fact, I graduated in the year of 1981, the year before all of you were born. I worked as a proprietary trader at Citibank at that time. Proprietary trader is a trader who can trade virtually everything on the bank's account. It was considered a very glamorous job. I use past tense. Not so much these days. I was selected as one of the recruiting members of the bank doing career talks in the East Coast of the United States for the purpose of attracting graduate talents to join the Asia Pacific Management Trainee Program. The team went to different campuses, including MIT, NYU, Boston University. One evening in Boston, there was an event in which each member of the recruiting team would be invited to give a speech that was related to his or her. When later on, when I use his or him, that means him and her together. That's a disclaimer. Related to his or her area of expertise. I was so confident of myself that I thought I could talk casually on stage. It, of course, didn't happen that way. When I was on the podium, I started to sweat. I couldn't think. My lips were dry. I could not talk in a sensible and coherent way. That was a very embarrassing fumble. Now, you may be thinking, why are you telling me this story? How is it related to the topic of today? I shall come back to that later. Now I should start to talk something about asset management. Give a very brief introduction about asset management. It may apply to both tangible assets, for example, real estate, physical gold, physical commodities, and to intangible assets such as intellectual property or financial assets. The term is most commonly used in the financial world to describe people and companies that manage financial investment on behalf of others. These include, of course, investment managers that manage the financial assets of a pension fund. In our discussion, we shall focus purely on financial asset management. I'm not going to talk about real estate, asset management, or other physical, tangible asset management. First, I would like to give you a brief introduction of different types of financial assets. If you are a finance student, I think most of you are, you may have some very good ideas of what I'm going to talk about. But for the benefit of those who may not be familiar with financial assets, and for the completeness of my presentation, I will introduce to you the common types of financial assets in the market. In view of the limited time, I cannot explain in detail some of the terminologies, some jargon. The idea is to give you an overall picture of the financial market. First, stocks. I believe everybody should have some ideas about stocks. We can categorize stocks on different bases. On the basis of ownership rules, we have common stocks, we have preferred stocks, and some hybrid. Hybrid would be like some capital securities that has the bond characteristics, but at the same time is considered part of the capital structure. On the basis of market capitalization, we have small cap stocks, which have market capitalization between US dollar 250 million to 2 billion. Example is Fairwood Holdings. You probably don't know what's Fairwood, but if I say Dai Wood, you all know what's Dai Wood. Fairwood has a market cap of US dollar about 480 million. So there's a small cap stocks. Mid cap stocks is with market capitalization from US dollar 2 billion to 10 billion. One of the examples is Haitong International, 海通國際, so subsidiaries of the bigger securities company in China. It has a market capitalization of US dollar 3.4 billion. Large cap is market cap over US dollar 10 billion. Example everyone knows is HSBC, market capitalization of US dollar 176 billion. It's dropped a little bit in the last 2 days, but still a large cap stock. On the basis of dividend payment, we have income stocks, growth stocks. Now, income stocks are stocks with relatively stable profit and dividend, but the slower growth compared with the growth stock. Growth stock would be stocks with high growth, but relatively small profit or even no dividend. Example would be Tesla Motor, never make a cent of profit in the history of the company, but the valuation is extremely high. Tencent, very large value generator, valuation also very high. On the basis of price trends, we have cyclical stocks and defensive stocks. Cyclical stocks will be stocks that are more affected by macroeconomic factors. Example would be consumer stocks, shipping stocks, which is highly correlated or negative correlated or highly correlated with the economic situation of the global economy. Defensive stocks are stocks that are more stable, not easily affected by changes in economic situation, utilities, 公共股, defense stock, those companies that are making fighter jet will be less affected by the general economic situation. On the basis of whether it's listed on stock exchange, we have listed stocks and unlisted stocks. And unlisted stocks, we commonly call them private equity. In fact, private equity enjoy a different class which has a different type of fund strategy that I'm going to talk about in a few minutes. Second, bonds. It is a general concept that bonds are considered safe assets with consistent returns. This is only partially true. That's true if it is government bond or corporate bond with high credit ratings. And for bonds with low credit ratings and long durations, the risk could be high because of credit risk or market risk. If longer the duration of the bond, the higher the sensitivity of its price being depressed by higher interest rate. So on the basis of maturity, we have short-term bond, the maturity from 1 year to 3 years. We have medium-term bond from 3 years to 7 years in general, and long-term bond, 7 years on higher. If we think that interest rate is going to go down, what are we going to invest? Long-term bond, because we would like to lock up our interest rate return. If we think that interest rate is going to go, I said go down, right? Previously, yeah, I said go down. If we think that interest rate is going to go up, we will buy short-term bond because we would like the bond to be mature so that I can reinvest at a higher interest rate. On the basis of credit, we have investment-grade bond meaning they have credit rating of BBB or above, or non-investment grade bond, BBB or below. Obviously, the lower the credit rating, the higher the risk of credit default. On the basis of issuer types, we have government bond, we have supranational bond, for example, bond issued by World Bank, Asia Development Bank, or corporate bond, for example, bond issued by Apple, Swire Pacific, New World Infrastructure. So let's quickly go to cash. Cash is an important asset class during high interest rate environment. However, in our zero interest rate environment, its role is more for liquidity rather than interest earning. Funds need to keep certain level of cash in order to satisfy redemption requests from investors. Commodities. Commodities as an asset class is usually classified as an alternative investment. It is because the price movement have low correlation with stocks or bonds. In traditional funds, where stocks and bonds are major asset classes, commodities could be added in small percentage for portfolio diversification purpose. However, there are many funds in the market that specialize in investment in commodities, not physical commodities. They usually use commodity futures to express their market view on the price trend of commodities. Different category of commodities, the most common type would be one, energy, crude oil, natural gas, metals and industrial metals, for example, gold, silver, copper. Agriculture, corn, wheat, soybean, livestock, cattle, hogs, pork belly. I don't know whether they still trade pork belly. Yes, no? Still trade pork belly, yeah. 豬腩肉都有得 trade. Then we have currencies. It's not very often we find a fund that purely invests in currencies, except for leverage FX hedge fund. In fact, I actually managed a FX hedge fund many years ago, about 20 years ago. 10 times leverage. That means the fund at that time is $50 million US. I can have a position up to $500 million US. However, currencies are important because their volatilities could affect the investment return of foreign stocks or bonds investment. For example, in 2016, last year, the investment return in UK stocks would be negatively affected by the depreciation of pound sterling after the Brexit referendum. Sometimes currency hedging is necessary in order to protect the investment return. Now I'm going to talk a little bit about different fund strategy. Oh, sorry. Now this is not an academic classification. It's based on my observation of the market and also a very general categorize of the category of the different fund strategy. First, long only. It's a very traditional strategy, very common, invested in stocks or bonds or a combination of stocks and bonds. Usually, no derivatives such as futures or option would be allowed in the investment guideline. This strategy's objective is to generate extra return, we call it alpha return, versus a benchmark. For example, if it is a Hong Kong stock fund, the benchmark would be very obvious, Hang Seng Index. If there's a US dollar bond fund, the benchmark could be 5 years US Treasury bond yield. Fund managers' objective is to outperform the benchmark. This is the idea of relative returns. When I worked in mainland China, in Beijing, I faced a lot of clients' inquiry about relative return because they just couldn't get it. Why? It's not because they don't understand it, they don't accept it. Fund manager performance is to measure against a benchmark. Imagine 1 year when the fund has a negative return of 5%. its loss is 5%. At the same time, the Hang Seng Index, the benchmark, dropped 7%. The fund manager can claim that he outperformed the market by 2%. Therefore, he has an excellent performance, even though his fund is losing money. So this creates a lot of frustration, especially if we have to face clients who always said that I don't care about relative return. What I care is the absolute return, whether I make money or not. It is a topic with a lot of arguments in the market, which I think I'm not going to expand here. Oh, this is, I'm showing you a little bit a portfolio of a typical stocks and bond balance fund. It's a US dollar base. There's the US dollar base portfolio. You can see on the left side is the stock portfolio. US stocks constitute 16%, foreign stocks 24%, REITs, real estate investment trusts 5%. And then stocks is 45% of the portfolio. On the right-hand side, you can see is the bond portfolio. Investment-grade corporate bond, 19%. Foreign government bond, 21%. U.S. Treasury bond, 10%. TIPS is Treasury inflation protection securities. Its coupon or interest rate is linked to the inflation index. So it's an inflation protected securities, 2%, and a high yield bond is only 1%. So you can see from this portfolio is quite conservative. It's not a very aggressive. It's very balanced, and also a high yield bond meaning low credit. It's only constitute 1% as a very little diversification. So this is an example of a very typical bond stock balance portfolio. Second, I'm going to talk a little bit about long-only derivatives or with derivatives overlay. This strategy is more flexible than the long-only. It allows the fund manager, under specific market situation, to use derivatives to hedge the risk of the underlying portfolio. Again, gives you an example. A fund manager is managing a stock portfolio. He's fully invested. If the global investment market runs into trouble, some of the black swan event happen, or in anticipation of a black swan, by definition, black swan event cannot be anticipated. But but you know what I mean. If the global investment market runs into trouble and the fund manager anticipates a major drop of the stock market, the fund manager can go short the stock index futures to hedge against the downside risk of his stock portfolio. There are many, many different combinations of using the derivatives market to hedge or to create value for the cash asset portfolio. This strategy gives the fund manager more flexibility to better manage the portfolio. Investor should look for higher returns because the fund manager has more tools to perform. Therefore, from an investor point of view, he should expect higher returns than the purely long-only strategy. Hedge fund. Hedge fund is quite loosely defined in the industry. In general, hedge fund has several characteristics. Number one, usually they can invest in a broad range of asset classes: stocks, bonds, commodities, currencies, very flexible. Second, they usually use a lot of derivatives, futures, options, different types of derivative strategies in options, interest rate swap, currency swaps. Third, leverage is very common. They will usually use leverage. In financial futures, the fact that you go into financial futures means that you have leverage already, because in most of the exchanges, for example, Hang Seng Index futures, you just put in I forgot how much, it's 5% margin, so we can trade the notional amount of a financial futures contract, which is much higher than the margin nominal amount that you put in. And the next, another characteristic is you can go long or short. Long only, you can always go long stocks, but in a hedge fund, you can short a stock, short something that you don't like, in order to make profit. I'll expand a little bit on the hedge fund strategy. There are in general 4 major types of hedge fund strategies. One called global macro. A fund manager will, based on research on macroeconomics or some of the industry return research, to take directional bets on the market. I'll give you an example. If the manager believes that global inflation is going to pick up, developed economies will perform better than emerging economies. His or her portfolio may be long US stocks, short emerging market stocks, short bond, long gold. Long US stocks because he's more optimistic on developed market economies. Short emerging market stocks because he thinks that is less attractive. Short bond because he thinks that inflation is going to pick up. Long gold, the same reason. Second type, event-driven. The fund manager captures market movement by anticipating events such as merger and acquisition or political surprises. Typical example again is Brexit. If the fund manager believes that the risk reward is attractive, betting on Brexit before the referendum, he may position his fund to long put option in British pound versus US dollar. Why use option? He long option because he has limited loss. If the referendum result is contrary to what actually happened, meaning UK will remain in the EU, he will lose money, but he just lose the premium. Therefore, option is a strategy that's very commonly used as well in order to capture some unexpected event. Third, long-short strategy. The fund manager attempts to generate superior return by long and short securities, stocks or bonds, by doing thorough company research. Again, give you an example will illustrate the idea. If the fund manager has a view that given the new wave of technological development, there will be some IT firms that are better positioned than others. His portfolio may be long Google, Facebook, Tencent, and short Microsoft, IBM, and Cisco. This is not a recommendation, by the way. Just an illustration. Market neutral. This strategy is a subset of the long-short strategy. Market neutral meaning you long something and then you short something. But your overall net position is always 0. A fund manager believes that the Chinese stocks will outperform the general market because he has a very bullish view on the mainland China economic development. So his portfolio may be long Chinese stocks and at the same time short the same notional amount of Hang Seng Index. This is one way. Another more direct way is to long the China Enterprise Index futures and short the same notional amount of Hang Seng Index futures. Okay? Private equity. Broadly speaking, this fund could cover all funds that invest in non-listed equities that offer attractive long-term investment return. These include leveraged buyout fund, mezzanine fund, distressed fund, infrastructure fund, etc. Just forget about the name. One major subset of private equity is venture capital fund. Probably you are quite familiar with that. The fund manager invests in equities of small and early stage startup companies, which have promising growth potential either because of its very unique business model or very new technologies. Since investment is made at early stage with relatively low valuation of the company, investment returns will be significant if the invested company can be listed through IPO or merger and acquisition in the near future. At the same time, investment risks are high risk, high return, because most startup companies have no or very little profitability and unproven business models, and thin resources in management expertise. Famous examples of successful companies that are financed by venture capitalists during their early stage of development include Facebook, Uber, Apple. So those early investors, they make huge return if they can keep their stocks after so many years. Lastly, but not the least, is a trend these days is algorithmic trading, algo trading. The strategy is using computer program to follow a defined set of parameters, trend lines, moving average, or breakout patterns, for placing trade orders that are usually with speed or frequency that's much faster than humans. It's all computer generated, or the program, and also placing the orders all through computer. Therefore, it's very, very efficient. Sometimes it's also called high-frequency trading. Now I'm going to talk a little bit about the new development in the industry. First, I think everyone aware is the opportunities created because of closer connection between the Hong Kong and mainland Chinese markets. The launches of QFII. QFII is in fact very, very long history. It allows foreign investors to invest into Asia in China before the Sum Gong Tong, Wu Gong Tong was established. QDII, RQFI, I just mentioned the name. I'm not going to explain it in details, otherwise I'll be overrun. For there is room for a lot more asset management products, innovation in Hong Kong. For example, a fund that is launched and based in Hong Kong and would invest in Asia in a Shanghai Stock Exchange and Shenzhen Stock Exchange. And very soon I was told that we can invest in bond as well on mainland China. Chinese companies, both state-owned and privately owned enterprises, have shown intense interest in the asset management business in Hong Kong. Now, asset management is an activity regulated by the Securities and Futures Commission, SFC. A company needs to have an asset management license, we call it Type 9, 9號牌, license issued by the SFC in order to conduct asset management business in Hong Kong. The application process usually takes a few months. A lot of Chinese companies, in order to be able to enter the asset management business quickly, prefer to acquire existing companies that have the license. The transaction premium price of a company with Type 9 license has increased dramatically in the last few years. Seems that you know the price. You know the price? What's the premium price right now? Huh? Say a million is on the 4 to 6 million for a company with a license without any business. Okay. Another notable development is the flourishment of independent financial advisory, IFA firm in Hong Kong and Singapore. One particular type of IFA, those firms established by seasoned wealth management professionals, private bankers, with the support of some wealthy families, set up their own wealth management firms. In contrast to wealth management services provided by traditional firms such as UBS, Credit Suisse, their value proposition is to provide independent wealth management advisory service so that they can select best services among different product providers in the market. In order to execute this business strategy, an asset management license Type 9 is also necessary. I expect these developments will continue in the next few years. It's evolving, it's going to happen in a much faster pace. Now I would like to provide some food for thought for you. As you may notice, one of the key success factors of different asset management strategies is good research. I just pick research as a convenient example. We need good research on macroeconomic factors such as GDP growth, inflation expectation. We need industry sector research, company research, in stock picking. In stock valuation, we need to use different valuation methodologies, models such as DCF, discounted cash flow, in order to derive the theoretical price of a stock. In portfolio construction, we work on correlations among different asset classes and build model portfolio that fits the risk-reward ratio. All these work are fundamental and critical to the success of a fund. But these jobs can largely be done in the near future, in my opinion, not by humans. Apart from Brexit, Trump's president election, Italy referendum surprise was the other piece of news in 2016 that attracted worldwide attention. Alva Go beat Li Zedong in Go competition. It was considered impossible in the past. Also, I think 5 or 6 weeks ago, another AI called Libertas, an AI computer program to play Texas poker, beat 4 top international Texas poker players in the United States and became officially the gambling king. AI has advanced so much that it can learn along the way. It continues to improve by its own or opponent's mistakes. Most humans cannot learn from mistakes, me included. Furthermore, compared to humans, AI is always objective and non-emotional. In the investment markets, it's definitely a strength. Can most research work replaced by AI in the future? Some, but a big portion of it will be replaced. It is because a lot of research work is based on a set of methodologies and theories. With the set framework, AI is not only the alternatives, probably a better choice than human. Can the role of fund managers be replaced by AI? I would say only some. Those who purely use research materials to make investment decisions, and those who use mathematical or statistical models to construct portfolio will be at risk. But human interaction and judgment cannot be replaced. After many years of operating in the market, market dynamic is not a combination of hard facts and data. It is composed of tens of thousands of market participants whose investment decisions are not necessarily a direct reflection of hard data. Successful investors know too well that they buy a stock not because they believe it is going to go up, but because they believe that other investors believe that the stock is going to go up. You follow? Okay. Now I digress a little bit. All of you recognize those 4 guys. What I've just said actually can have similar mentality in areas like our chief executive election. Imagine the thinking of some members of the Hong Kong SAR Chief Executive Election Committee, 選舉委員會的委員. They cast their votes to the one whom they think will win, not to the one whom they think is the best. But that's important in daily life, probably. Based on some very successful fund managers' experience, the best pick in stock are not necessarily those companies with the best business models, or highest profit, or excellent growth profile, or healthy balance sheets. Their best buy, or sometimes more importantly, best sell, come from interaction with the key management of the company. through interaction and sharp observation by the fund managers and investors, they make their best buy or sell decision once they finish the meeting. Oh, not yet. Conclusion. Now I should come back to the first part of my speech, which I mentioned a fumble in a university in Boston. I brought this up because I would like to emphasize the importance of human communication and interaction, which is very important. It cannot be, I hope, and I think, and I believe, will not be replaced by AI in the future. With the technological advancement, particularly AI, the financial industry, asset management included, will undergo dramatic change in the future. Things that cannot be replaced, in my opinion, are, number one, the importance of the ability to communicate and interact. It is not only applicable in asset management, but in everyday life. Good communication can be trained. It is not born, but can be perfected through repeated practice. I did it myself. I was a lousy speaker before. Now I can talk a little bit. The second, the importance of getting well prepared. It is common sense, but people just always neglect it. It is a cliche, but very true. Luck will always fall on those who are well prepared. Third, the importance of learning from mistakes. Sometimes bad experience may not be that bad, as long as we can learn from it. AI can do it, humans can also do it. I hope we all learned something today. And I hope instead of a fumble, it's a touchdown. Thank you.